There's a common misconception among so many investors that it's not worthwhile to order a depreciation schedule for a property that was built before 1987. Here's why that's not the case at all. Hi everyone, Kim Koch from Geotax, here for another video designed to help you become a better property investor. The date, age, and type of property all have an impact on what you can or cannot claim on depreciation. According to Australian tax law, the capital works component of depreciation is strictly qualified by age. So, basically, where construction commenced for a residential property before 15 September 1987, you won't be able to claim capital works deductions. But nothing is stopping you from claiming depreciation on the property's plant and equipment assets. In fact, in many of our clients' situations, we have identified a large portion of available deductions on older properties through plant and equipment depreciation. And if any extensions or renovations were completed after 1992, they will attract a capital works allowance. In today's video, I want to share with you just how one of our clients was able to save $2,146 on his first year of owning his investment property, even though it was built before 1987. Before we get into why you can still benefit significantly from depreciation on an older property, we want to be clear that this video is for informational purposes. In no way should you interpret this as tax advice. We always recommend working with a qualified accountant or tax agent to give you the best advice for your situation. So, Oliver purchased a house for $439,000 that was originally built in 1980. He generates $400 in rental income per week, which means he's earning around $20,800 each year. But it's costing him about $24,854 per year to maintain the property and cover the rates and interest repayments. He ended up renovating the kitchen and bathroom and installed new blinds and floor coverings. So, Oliver could claim a capital allowance for the renovations and depreciation on the newly installed plant and equipment assets. Because he got his hands on a depreciation schedule as soon as he purchased the property, he didn't miss out on any savings. But for comparison's sake, I want to show you the comparison between what his cost breakdown would be like if he didn't claim depreciation. So, after subtracting the property's expenses from the rental income, we can see that he is running at a loss of $4,054. Oliver's marginal tax rate is 37%, so his loss would have resulted in a $1,500 tax refund from the ATO. This means that the annual cost of his investment property would have been $2,554, which is $49 that he would have to contribute each week. But because of our quantity surveyors were able to identify $5,800 worth of depreciation, Oliver ended up getting a tax refund more than double what he would have gotten without a depreciation claim. His refund ended up totaling $3,646. So, his annual cost only amounts to $408 each year. That's only a weekly loss of $8. This means that Geotax saved Oliver a total of $2,146 in his first year of owning the investment property. The great thing about his depreciation schedule is that it's valid for up to 40 years. So Oliver can continue saving money each year as long as he continues to own the property. So, the point I'm trying to make is don't underestimate the impact these savings can make. Even if your property was purchased before 1987, there might still be room to effectively minimize your tax and boost your cash flow. If you would like to know if your property qualifies for a depreciation claim, get in touch with us to get a free estimate on the phone. The other option is to check out our free rental property calculator on our website that you can use to estimate your potential savings. So make sure to check that out. We've left a link in the description box below. And if you know a friend, colleague, or family member who needs to hear this, please make sure you share this video with them. That's it from me. I'm Kim Koch from Geotax. See you next time.